So can we make the case that new highs are remotely possible? We actually can. And I know that that sounds so out of left field right now. People are just so bearish. But hear us out. I am looking at our latest insights piece at MAPsignals.com. Our macro analyst, Alec Young, really makes an amazing case that, you know what, you don't want to be betting against stocks right now. So let's get through a lot of awesome macro charts. This is going to be a longer video than usual, but it is so powerful and I love it. So let's go ahead and start now. So Goldilocks makes a comeback. So this is an amazing chart here. Alec has plotted out a few things. One, the GDP growth. He's got the Fed funds rate, he's got core PCE, and he's got the 2-year Treasury yield. Okay, there's a couple of things to point out here. Number one, core PCE, it has peaked and it is starting to fall, right? So inflation is starting to moderate. Now, here is the key to this chart. Notice the green line, that is the 2-year Treasury yield. Notice how it spiked before the Fed started raising interest rates at one of the fastest paces in history. Well, get this, the 2-year Treasury yield is a leading indicator, and a lot of people are saying that, listen, wherever the 2-year Treasury yield goes, the Fed is going to follow. Notice that the Treasury yield has been falling rather fast, and so the bet is that the Fed is near done, okay? Near done, and there is the case that they could be lowering interest rates, which of course would start to stimulate the economy. So net, this is a positive development, amazing chart. Let's get to the next chart you want to be focused on. All right, everybody's worried about the banking stress, right? We've had some notable collapses, right? We had Silicon Valley Bank a few weeks back, but here we're looking at the Bloomberg Financial Conditions Index, right? And basically, if this blue line is above the red, well, that tells you, look, conditions are easier. And if it's below the red, conditions are tighter. So look, there was a lot of tightness that happened in 2020 with COVID and all of that. But look, right here, the Fed has started to ease conditions, right? Because they have expanded some of their balance sheet to help out some of the banks. And the point here is that the markets are taking the bank mess in stride. Let's get to the next chart. This is really fascinating. And basically, Alec is saying that the Fed is likely done, right? There is one more, maybe 2 rate hikes that are coming down the pipe. But basically, a lot of those hikes, it's already priced in. So check out this chart. It's looking at the Dow Jones Industrial Average, okay? If you go back, this is 1974, with the date of the last Fed hike, okay? And this is telling you the Fed funds. What did the Dow Jones do 3 months later and 6 months later? So get this, on average, 3 months later after the last Fed hike, which we believe is coming soon, the Dow Jones is up almost 2% 3 months later, and 6 months later, it's up about 3.5%. So again, the picture based on history is favorable for stocks as we get close to the last rate hike. We got to keep going. So you may be wondering, well, how many months on average does the Fed wait from the last rate hike to the first cut? Well, look, we're going all the way back to 1957. I mean, this is, 60 years of data, right? Look at this, 3.4 months between the last rate hike to the first rate cut. So if you think rate cuts aren't coming, history says that once they are done, it's going to be months later. So again, that is constructive for stocks. And then let's look at another chart. Look, this is great. I mean, just keeps going over everything. People are worried about earnings collapsing. Well, you know what? It hasn't happened right now. Earnings continue to be a lot better than feared. And so look, Alec is making the case that investors, big institutions, they're going to look through a lot of the negativity that's already priced in stocks. Remember, markets are forward thinking, okay? They are going to discount a lot of the negative news out there. For 2023, the estimates right now is that the S&P is going to make $220 per share. In 2024, 248 is the estimate. So what's that PE ratio? It is 18.6 for 2023. It drops to 16.5 in 2024. So look, it's not that crazy expensive. Let's get to the next chart. This is really awesome. Talking about valuations. A lot of people are saying, oh, the market is still overvalued. But you know what? You got to dig a little bit deeper. And this chart actually does this. The S&P 500, the 12-month forward PE, it sits at 18, which is on the rich side, but it's not crazy rich, right? Below 20 is within historical reason, okay? But check this out. If you do an equal weight of the S&P 500, okay? Remember, there's about 10 stocks that make up a big chunk of the S&P 500, right? Because it's market cap weighted. If you equal weight it, that forward PE drops to 15.5, okay? So that is not terribly expensive. And then if you look at small caps, this is where the opportunity starts to reveal itself. The small cap 600 12-month forward PE, it is at 13.4. So there are a lot of stocks that are on the cheap side that investors really need to be focused on, okay? Some of those popular big tech companies, they might not be where the opportunity is. It might be in some of the areas that are least covered, and those are small caps. Now let's turn to MAPsignals, right? What's the BMI doing, right? That's the flow of money that we are measuring. Well, right now, we are kind of in the lower area, right? A BMI of 37, okay? Now remember, if you look back over the past 6 months, when the BMI starts to rally, right, starts to ramp like it is now, markets tend to go a little bit higher. You can see that here. You can see that here. So tactically, we are seeing that the BMI is set to rise, and that is near-term bullish for stocks. But let's keep going. How do you play it, right? What areas do you want to be focused on right now? Look, he is still making the case that technology has some great opportunities. We can see that that is the highest ranking sector right now, and it has been for this year. Number two is also discretionary. That has been the other area that we've been seeing a lot of institutional buying in that group. A couple of other areas of interest that Alex wants to point out is staples is looking really good. You can see that it is a number 5 ranking. There are a lot of solid best of breed dividend growth stocks in there. And then also healthcare. If you want to have a little bit of defense, no matter what the economy is going to do, they're going to be spending money on their health. So healthcare, he sees that as very attractive given that it is 7th ranked. It probably has a little bit more catch up to do. So look, make sure you guys really look at the data. Don't listen to all the bears. MAPsignals here is just trying to showcase another narrative. Things aren't as bad as they seem. And remember, like and subscribe to our YouTube channel. It really helps us out. And make sure to share this video because this narrative out there that the world is ending, I just don't know that that's going to happen. I'll talk to you guys next time.